Half a day, everyone. My name is Gerald Tan, and I'll be presenting on Chapter 17 together with Paolo Sorio and Solmar Tolentino. Okay, let's get started then. This chapter begins by introducing the Federal Financial Management Improvement Act of 1996. The simple explanation is that this allows for accountability and credibility of the federal government by requiring federal agencies to maintain sound financial management systems. Along with the requirement, major agencies must issue performance and accountability reports, which comprise of two components, the annual performance report and the audited financial statements. So this act of Congress is obviously requiring federal agencies to comply with some sort of standards, but who exactly is prescribing these standards? Well, federal statutes, particularly the Budget and Accounting Procedures Act of 1950 and the CFO Act of 1990, assigns three principles their responsibility. The U.S. Comptroller General, the U.S. Secretary of the Treasury, as well as the Director of the Office of Management and Budget. These three principles comprise the JFMIP, also known as the Joint Financial Management Improvement Program, and together they establish the Federal Accounting Standards Board, FASAB. We've talked about this in the past. So let's get down to the specifics. As we've learned in the past, the FASB and the GSAB both have conceptual frameworks that provide the basis of reporting. FASAB is no different. In fact, it follows a very similar pattern to that of the GSAB and the FSAB. Now, I know there are 9, but the text only highlights the first 8, so those will be our focus. Let's talk about statement of Federal Financial Accounting Concepts number 1, SFFAC number 1. This basically tells you what are the objectives of federal financial reporting. Well, there are 4: budgetary integrity, operating performance, stewardship, and adequacy of systems and controls. Next, we have the concept statements number 2, which basically highlights what constitutes a reporting entity. It gives you 3 criteria for testing. 1, there must be an identifiable, and this is the keyword, identifiable, management team that can be held accountable for the entity's performance. 2, the financial statements produced by the entity must be meaningful. And 3, there must be users who are interested in this information within the financial statement produced by the entity. Next, we have a concept statement number 3. It provides guidance for the MD&A included in federal financial reports. It fulfills pretty much the same purpose as before in that it provides management's insights as well as increasing the understandability and usefulness of federal financial reports. But one striking difference between the FASAB and the GSAB is that the MD&A and the FASAB requires that federal agencies address the reporting entity's performance, goals, and results in addition to the financial activities. Next, we have concept statement 4, which basically expands on statement number 1. It mentions that citizens and their intermediaries are the primary audience for federal financial reports, and because of that, the reports must be general purpose, and that it's easily understandable by most citizens. Moving on, number 5, concept statement number 5 basically defines the elements of financial reports. It's very similar to GSAB with your assets, liabilities, net positions, revenues, and so on and so forth. One of the biggest differences, though, is that it does not include deferred inflows and outflows of resources as an element in the financial statements. Okay, next we have concept statement number 6. It's an amendment to statement number 2. It provides guidance on when financial statement information should be classified as basic information, required supplementary information, or other accompanying information. Again, it's very similar to before, so I'll not be going over it. Okay, concept statement number 7 talks about how to record assets and liabilities at a date different from the acquisition date, typically the future. It allows for comparison and gives standard setters the information they need to decide on which information would be most useful for decision makers. Lastly, we have a concept statement number 8, which aims to enhance the understanding of conceptual frameworks. It discusses the roles and relationship between various financial statements, and it's essentially a restatement and clarification on previous frameworks deemed by the board to be important for users to better understand. I'll now be handing off the presentation to Paolo and Solmars, who will be discussing a few more topics from Chapter 17 before we close off.
Now, Paolo and I will be discussing accounting and reporting for federal agencies. So the accounting system of federal agencies follow a dual track approach, the first being a proprietary and the second being budgetary. And this is because the system has to provide financial management information as well as information regarding budgetary and legal compliance. So when recording journal entries for different events, you may be dealing with only proprietary accounts, or you might be dealing with just budgetary accounts, or you might be dealing with both just for one event. And the proprietary side is meant to provide information for agency management, and the budgetary side is to ensure that resources aren't being overexpended or over obligated, and to facilitate standardized budgetary reporting requirements. And to give you a better understanding of this dual track approach, we'll now look at journal entries. So entry 1 is to record appropriations passed by Congress to fund our operations. So we'd record this on both tracks, budgetary and proprietary. And then entry 2 is to record the apportionment of appropriations approved by the Office of Management and Budget. And this is only recorded on the budgetary track. Entry 3 is to record the allotment of authority by the agency head, again only record on the budgetary side. Entry 4 as well, only on the budgetary side to reserve authority before we formally order goods or services. And then entry 5, again, no entry on the proprietary track because we're recording goods or services ordered. And then entry 6, now we're dealing with the proprietary side. We're recording a request for a check from the Treasury to be written and issued to our vendors. The disbursement in transit is a liability account, and this doesn't reduce our fund balance with Treasury accounts only until the check has been issued, which happens in entry 7. We're recording the notification that our check has been issued by the Treasury, so now we can reduce our fund balance with Treasury accounts. And then entry 8 is to record the receipt of goods or services, but these were ordered in a prior fiscal year. So entry 8A is to show that these obligations were liquidated and will expend appropriations by the same amount. And then 8B is to increase our asset accounts because, of course, we received our goods, and because we received goods, we now have to credit accounts payable because now we need to pay our vendors. And since our appropriations were expended, now we need to debit unexpended appropriations to show that they have actually been expended. And then entry 9 is to again record the receipt of goods, but this time these goods were ordered in the current year. And since the estimate was short, it caused a difference of 5,000. So now we need to decrease our allotments account to make up for the increased expenditure shown in entry 9A. And then entry 9B is the same concept as entry 8B as shown previously. Then entry 10, we're recording payroll and utilities. So these are recurring expenses, so we don't need to record commitments or obligations. Entry 10A is to record the authority being expended for these expenses. And then entry 10B is to record a request for a check to be issued again. Then entry 11 is to record the usage of materials and supplies. This one's pretty straightforward. Entry 12, we're recording the approval of accounts payable from prior transactions. So now we need to ask the Treasury again to write more checks and issue them. And because of that, we're recording a liability with the disbursements in transit. And then entry 13, these checks were issued by the Treasury. They told us, so now we need to clear out that liability and decrease our fund balance with the Treasury. And entry 14 shows adjusting entries for preparing accrual-based financial statements. Payroll was accrued and invoices for goods were received, but payment wasn't approved yet. And some of the goods we received were already used up. Authority was expended to the extent of these two events. And then expenses, assets, and liabilities accounts attributable to this transaction were also increased. And since authority was expended, we'll also record the proprietary equivalent of entry 14A. And then lastly, entry 15, straightforward again, we're recording depreciation expense. And now Powell will carry on with our presentation.
Hi everyone. Thank you so much, and continuing learning objective 5, I will finish the entries and demonstrate some federal financial statements. Prior to the preparation of the statements, the federal agency must close any lapsed budgetary authority. Debit to the total credit of expended authority summed to 2.45 million. Total unexpended budgetary authority ended at 50,000, and 34,000 of that amount is undelivered orders pending at year end. The 6,000 debit in commitments and 10,000 debit in allotments is not a reserved account, and in accordance must return to the Treasury with the closing entry. The second entry in proprietary ledgers is to display withdrawn appropriations in the federal agency. Shown is an illustrative example of a federal agency's pre-closing trial balance, and it's similar to the one you see in other formats: debit balance and assets, supplies and equipment, fund balance, normal credit, payable liability, balances with the addition of used appropriations, and normal debit balance for expenses. One difference in this same trial balance is the reporting of budgetary accounts, and it reports appropriations realized throughout the fiscal year, appropriations not used, and other appropriations realized alongside apportionments, allotments, commitments, and undelivered orders. Now we will be looking at the U.S. Department of Education to illustrate the usual financial structure of the federal financial statements in lesson objective 5. The first one being balance sheet, as you can see, and it involves intergovernmental balances, and it follows with the fund balance with Treasury. This is followed by the governmental assets. In DOE's case, they have loan receivables, credit programs, and especially the most significant, the direct loan program, which is the common student loan program that with little to no interest that is paid by DOE to the students. Liabilities of Fed agencies usually have accounts payable and other intergovernmental liabilities. DOE's most significant liability is the direct loan program, and this includes the expenses they cover for students, and they also have the FFEL program, the Federal Family Education Loan Program, and this was a private student lender, but now is guaranteed by the federal government to utilize. And there is a net position that covers unexpended appropriations throughout the fiscal year, and cumulative results of operations is the difference between the expenses and transfer outs against the revenues and transfer incurred. The next financial statement covered is the statement of changes in net position, and it is a significant difference of this statement compared to other changes discussed in our class, and that difference is a section of budgetary financing sources. Usually this ties in with appropriations used and received, and DOE generalized their statement by not including specific categories. The end of the statement reports a net change in net position. The next statement covered in this learning objective is a statement of budgetary resources, and it reports the status and availability of resources at the year end. It presents the net disbursements at year end, and to simplify it, the notes that are integral with the budgetary resources with DOE outline that most of the activity of their budget resources revolve around COVID-19 activity and direct loan program. The statement of budgetary resources with the related disclosures can provide insightful information of the approved budget and the availability of these resources at the end of the fiscal year. One note at a first glance from DOE is that their budget of new obligations between FY21 and 2020 has a significant difference. And users may ask themselves what were the issues causing a lower budget for this federal agency. Finally, we have the statement of net costs. This financial statement concludes components of all the mission areas of DOE. As you can see, all of these programs are dedicated for providing funding for government institutions. FFEL provides the loans, credit programs for the higher education, and direct loan program to offset some education costs for students. This statement focuses on the cost against earned revenue of each major mission of the federal agency. This concludes our presentation on Chapter 17. Thank you very much.